So ever since the recent stock market crash all throughout the month of March, you guys know that I've been making a ton of videos talking about stocks that I would like to buy. Like Canadian bank stocks going on sale and some of the top dividend stocks going on sale, and even MasterCard and Visa starting to see a little bit of value. But honestly guys, the market keeps changing so rapidly I can barely keep up, as you can probably tell from the title of this video. Right now, the S&P 500 is only down just over 15% off its all-time highs in 2020 after recovering over 25% from its bottom on March 23rd. All of this recovery, yet we're seeing the worst economic shock in history in terms of low demand and unemployment across the globe. In fact, at this point, most people are concluding that a recession is inevitable and that it could be the worst one that we've ever seen. So overall, things really aren't seeming to line up in the stock market when compared to what's actually happening in the real world. So in this video, I'll be trying my best to explain exactly what's happening in the market right now and the reasons why I'm not going to be buying into stocks at the moment. And instead, I'll be explaining exactly what I am doing right now and what I plan to continue doing over the next few months. So if you do enjoy this video, make sure to smash that like button down below for the YouTube algorithm. It does really support my channel. And if you haven't already, definitely consider subscribing for more weekly investing videos just like this. And so with that being said, let's get into the reasons why I plan on not buying into stocks at the moment. Alright guys, now one of the most important reasons why I'm not going to be buying into stocks right now is because of the overall market valuation. And the first thing that I want to talk about is the average PE ratio of the S&P 500 at the moment. As we all know, the PE ratio is the price to earnings ratio, and when looking at the S&P 500, it would be the share price of the S&P 500 index divided by the earnings of all of the companies over the past 12 months. And typically we as investors will use this price to earnings ratio to help determine how expensive a stock might be, but the same can apply to the overall general market. Now at the time of making this video, the current PE ratio of the S&P 500 is sitting just above 21. Now that number alone doesn't really tell us a whole lot about the valuation of the S&P 500, so we have to look at historical standards, and in the past, the average historical PE ratio for the S&P 500 has been 15.8. So basically what that means is that investors are paying over 33% higher than normal for these companies, even in such a horrible economic time. But sure, you might be able to argue that the PE ratio only tells a little bit about the entire story of the stock market. So let's take a look at something else called the price to book ratio, which actually shows the underlying equity value of these businesses. So what we find is that the current price to book ratio of the S&P 500 is sitting just above 3.1, while over history, it's actually been about 2.8 on average. So we might not be sitting just as high as how we were right before the dot-com bubble in year 2000, but it is still cause for concern because we are above the average historical price to book ratio. Now, in my personal opinion, it really doesn't make a whole lot of sense how we're entering 2020 with such a high valuation on both the price to book and the price to earnings ratio front. Meanwhile, the economies of most countries in the world are shut down right now with only essential businesses running. And all of that brings me to the second point that I have here on my list today, and that is to talk about the upcoming earnings season. Alright guys, so what do we know at this point? We know that we're in the infancy of the earnings season for Q1 in 2020. Most companies have not reported earnings up to this point. Now we all know that the market is a forward-looking machine. It prices in the future of equities and how these companies are going to be doing in the future. However, I personally believe that the market is not pricing in this earnings season. Now to justify my reasoning behind that, let's take a look at some companies that have already reported earnings to date. Now Johnson & Johnson was one of the first big companies to actually end up reporting earnings in this earnings season, and surprisingly they actually killed it. They had earnings per share of $2.30 while analysts predicted $2. And although their share price went up over 4% on the day, along with a positive day in the market, they actually cut their guidance by over 15% throughout 2020. Now, of course, this is only one company out of the top 500 companies in the S&P 500. However, Johnson & Johnson is known as one of the most stable and secure businesses to always be able to increase their dividend and make earnings, yet they still cut their guidance by 15% in 2020. So what does that tell us about many of the other companies that may have more shaky business models or that actually haven't been doing business over the past month? Now, to illustrate my point further, let's take a look at some of the US banks that have reported their earnings to date, because banks simply are the backbone and the true foundation of the economy. Well, JP Morgan reported earnings of 78 cents per share, while analysts were actually expecting $1.84 per share. And that is because the bank was adding tons of provisions for loan losses coming up in the near future. So what does that mean? Well, JP Morgan is predicting that a large portion of their loan portfolio will be defaulting on those loans because they simply can't make the payments in this economic environment. But it wasn't just JP Morgan. The same thing actually happened for Wells Fargo, coming in with earnings of only 1 cent per share when analysts were expecting 33 cents per share. So obviously we're going to be seeing this across the board for banks, and obviously for many other companies out there if the banks are hurting already. And personally, with the way things are going, I honestly don't see us having any earnings growth over the next possible quarter or two, except for some companies like Amazon and Clorox that are actually benefiting from this environment because they are essential businesses. So getting back to my first point about the valuation of the market, the fact that we're currently overvalued and then earnings are likely going to decrease further, we're looking very, very overvalued. And so if earnings decrease in the next year, the current price of the S&P 500 will be divided by a smaller number than this year, and that means that the PE ratio is going to be going up, and we will be looking a lot more overvalued. And like I said, since we haven't seen the majority of the earnings come out for these companies, we're essentially blinded with this valuation of a 21 PE ratio because it could be a lot higher in actuality. Now, on the other hand, some would argue that the market is pricing in future events after the current issues in the market have passed over, which could totally be true because the market is a forward-looking machine. And that brings me to my third and final point, which is that I believe we're going to be seeing a slow economic recovery. Now guys, I'm no fortune teller, but I don't personally believe that we're going to be recovering as quickly as some people think we will be as soon as these issues are gone in the market. And to illustrate my point behind this, let's first take a look at some of the recent jobless claims reports in the United States. Now, as we can see, everything was going steadily along at low unemployment until the week ended March 22nd, when unemployment spiked to over 3.3 million claims, and then a week later it doubled to nearly 7 million claims. And guys, keep in mind, these are the largest number of jobless claims in history by a long shot. Yet we find the stock market only down just over 15% on the year. It sounds very suspicious, so what's going on? Well, personally, I believe that the market is pricing in two different factors. First of all, I think the market is pricing in a V-shaped recovery, where essentially you drop very quickly and then recover very quickly. And to date, the stock market has been recovering very quickly. And secondly, I believe that the market is pricing in the most optimistic scenario in which the economy reopens, which could be at the beginning of May. But as investors, what we have to realize is that the economy is not just going to open up again as quickly as Trump wants it to, whether it be a start date of May 1st or May 31st. It really doesn't matter. It's about the confidence of people going out there, spending time in public again, and actually buying products out in public. And by the same token, we can't expect all of these people that have recently been laid off to just all of a sudden get their jobs back like that. Many companies are taking major losses out there if they actually survive and don't go bankrupt, and this might actually take them years to recover from the current scenario in the market. And that likely means that a lot of these companies are not going to be rehiring all of their workforce at once. It might only happen in chunks, and they might actually realize that they're more efficient with a smaller workforce, so they may not have to hire all those people back. And of course, with this higher unemployment, that means there's less money to be spent out in the market, and businesses generally won't be doing as well as they did before this whole thing happened. So for that reason, I personally believe that even when the government reopens the economy, it's not going to be thriving as it once was. It's going to take months, if not years, to fully recover. So that brings us to the question, am I a buyer in the stock market with the S&P 500 down just over 15%? Absolutely not. As for now, I'm just going to be building up the amount of cash that I have in my high interest savings account, and then if the market does correct itself again, potentially past the 30% correction point again, I will be taking advantage. I'll be a lot more interested at a discount of about 30% or more off the all-time highs, because then at least a lot of these future events and terrible things that will be happening that we haven't yet seen will be priced into stocks. And of course, the risk return value will be phenomenal compared to how it is right now in the market. And so that's why I will only be a buyer if it goes down a little bit more. And with that said, thank you guys so much for watching the video. If you did agree with my thesis, let me know down below, or if you're a buyer of stocks, also let me know. So if you did enjoy this video, make sure to smash the like button to support my channel. And then if you haven't already, definitely consider subscribing and hitting that bell icon down below for more weekly investing videos just like this. And I will see you guys in the next one.